Today, risk on in tech and financials. Hello again, it's Martin North from Digital Finance Analytics, one latest post covering finance and problem news with a distinctively Australian flavour. Well, it seems we've learnt nothing from the GFC, as the parallels with Washington Mutual in the early days of the 2008 crisis, a hallmark event that triggered a financial crisis that hobbled the economy for years, emerges once again. Whilst the 2008 crash prompted tougher rules in the US and beyond, Silicon Valley Bank became the biggest US lender to fail in more than a decade after a tumultuous week that saw an unsuccessful attempt to raise capital and a cash exodus from the tech startup that had fueled the lender's rise. Regulators stepped in and seized it on Friday in a stunning downfall for a lender that had quadrupled its size over the past 5 years and was valued at more than $40 billion as recently as last year. The move by California state watchdogs to take possession of the bank, known as SVB, and appoint the Federal Deposit Insurance Corp as receiver adds to the turmoil in smaller lenders caused by the US's rapid interest rate increases. Just days earlier, Silvergate Capital Corp announced it was shutting its bank down, spurring a broader sell-off in industry stocks. Banks were already suffering from the jump in rates that eroded the value of their portfolios, and meanwhile customers in the technology and crypto startup worlds were yanking cash amid a slump in their businesses. In SVB's case, the turmoil fed on itself as customers worried about its health rushed to withdraw money. Bank runs are a lot about psychology, and at this point it's very rational to be nervous, said Saul Omavra, a law professor at Cornell University. In Washington, the situation prompted a series of discussions among top regulators, and Treasury Secretary Janet Yellen called a meeting on Friday with leaders from the Federal Reserve, the FDIC, and the Office of the Comptroller of the Currency to discuss developments around SVB. Yellen said in a statement that the US banking system, quote, remains resilient and that the regulators, quote, have effective tools to address the fallout. But the S&P 500 slumped last Friday amid fears of contagion that swept through banking stocks as regulators closed SVB Financial to protect customer funds after the beleaguered bank's efforts to secure funding failed. The S&P 500 fell 1.4%, the Dow Jones Industrial Average fell 1%, and the Nasdaq was down 1.8%. SVB Financial Group was closed by regulators and its deposits placed under control of regulators to protect depositors following a run on deposits after its parent company's share price crashed a record 60% on Thursday. In fact, on Wednesday, March the 8th, Moody's still had an A3 rating on SVB Financial, owner of the now defunct Silicon Valley Bank, as it was already collapsing for all to see. 4 notches into investment grade, a very respectable rating. In the evening of that day, after SVB disclosed the $1.8 billion loss on the sale of bonds, a planned capital raise and a slew of liquidity measures, Moody's downgraded it by just 1 small notch to Baa1, still 3 notches into investment grade. And then on March the 10th, after Silicon Valley Bank was shut down and put into receivership, Moody's downgraded SVB by 13 notches in one fell swoop, all the way across junk territory to its lowest rating to C, which is Moody's rating for default. And it said that it will withdraw the rating. So once again, you can see that credit rating agencies and ratings are pretty meaningless. In the latest update regarding the rapidly moving SVB Financial Group saga, the Federal Deposit Insurance Corporation said on Friday that SVB has been shut down by the California Department of Financial Protection and Innovation. The regulator, which appointed the Federal Deposit Insurance Corporation's receiver, revealed that the FDIC created the Deposit Insurance National Bank of Santa Clara to protect insured depositors at $250K. The FDIC as receiver immediately transferred to the DINB all insured deposits of Silicon Valley Bank, the FDIC said in the statement, and added that all insured depositors will have access to their insured deposits no later than Monday, March the 13th. The FDIC said it will pay uninsured depositors an advance dividend within the next week. And for any remaining uninsured funds, depositors will receive a receivership certificate. As the FDIC sells the assets of Silicon Valley Bank, future dividend payments may be made to certificate holders. The SVB plunge started on Thursday after it revealed that it had to sell billions of dollars worth of securities at a loss and was seeking to raise $2.25 billion in equity to shore up its balance sheet. That caused a wave of concerns hitting other bank stocks in the process. As at December 31, 2022, SVB had around $209 billion in total assets and approximately $125.4 billion in total deposits, although the FDIC said that at the time of closing, the amount of the deposits in excess of the insurance limits was undetermined. The amount of uninsured deposits will be determined once the FDIC obtains additional information from the bank and customers, they added. And they also confirmed that the DINB will maintain SVB's normal business hours, with banking activities resuming by Monday. The news sparked widespread fears of a spillover into the broader banking sector, with regional banks, which tend to have less diversified funding sources than the larger peers, in the firing line. Signature Bank and First Republic Bank were down more than 18%, while JP Morgan Chase and Wells Fargo were in the green amid expectations that depositors will seek safety in larger banks. The turmoil in banks triggering worries about a seismic banking crisis forced investors to rethink their bets on large rate hikes at the Federal Reserve's March meeting, even as job gains in February topped estimates. The US economy created 311,000 jobs last month, well above expectations, though there were some signs of softening in the labour market, including a tick-up in the unemployment rate and slower wage growth. It's hard to say that cracks are forming in the labour market when payrolls increased 311,000, but it seems like we are at least at the beginning of the process of seeing the labour market soften, Jeffries said in the note. The US economy continued to create jobs faster than most expected in February, but wage growth eased and the average workers' working hours fell, suggesting that the labour market is indeed starting to cool. Now, turning to those job numbers again, half of the new jobs created last month were at service-side companies such as retailers at 50,000, restaurants at 70,000 and hotels at 14,000, businesses whose employment has still not returned to pre-pandemic peaks. Government at 46,000, white-collar professional businesses at 45,000, healthcare providers at 44,000 and construction companies at 24,000 accounted for the rest of the increase in hiring in February. Government employment has played a big role in the surge in jobs in the first 2 months of 2023, with a combined 164,000 new jobs. Such an unusually large increase is unlikely to last, of course. Employment fell in transportation, perhaps because of slower consumer spending on goods purchased online. And information companies, mostly high-tech and media, also reduced employment. A spate of businesses such as Amazon had announced job cuts in recent months. And there were some signs the labour market is loosening a bit. The small rise in hourly wages, for example, left the increase in pay over the year at 4.6%. Now that's down from a 40-year high of 5.9% 1 year ago, though still well above the 2 to 3% growth rate that the Fed would like to see. Hours worked also slipped a touch to 34.5 hours a week. Companies usually reduce the number of hours an employee works when business is slow. The share of working-age people in the labour force, known as the participation rate, edged up to 62.5 from 62.4. It was the third straight increase and the highest level since early in the pandemic in 2020. When more people look for work, companies don't have to compete as much for workers via higher pay. The Labour Department said non-farm payrolls rose by 311,000 through to the middle of the month, well above the 205,000 consensus forecast, but down from a revised 507,000 in January. January's numbers had been distorted upwardly by seasonal adjustments and other statistical quirks. While the headline number was above forecast, key elements of the survey pointed to a slight weakening in the labour market. Average hourly earnings growth slowed to 0.2% rather than staying at 0.3% as expected, while the average number of hours worked edged down to 34.5 from 34.6. Gilles Mike, chief economist with French asset management giant AXA, said that the report was consistent with the Fed raising the target range for Fed funds by 25 basis points at its meeting in 2 weeks' time, in as much as it had not borne out fears of inflationary pressures rising again. Fed's hesitation is on the calibration of the next hike, not on whether or not it should hike. So today's payroll is probably enough to keep them at 25 basis points unless we have a freak CPI next week, Mike said. At the same time, he added the labour market still remains too strong for the Fed to contemplate ending its hikes and contemplating any lowering of rates. The unemployment rate rose to 3.6% from 3.4%, while the percentage of working-age adults in the active workforce reached its highest since the early days of the pandemic, inching up to 62.5% from 62.4%. Both of those indicators suggest a modest improvement in labour supply, which has been nowhere near the level needed to fill the vacancies created by the disruption of the pandemic. US stock futures turned positive after the release, which pointed again to a scenario resembling the Federal Reserve's desired soft landing for the economy. And while jobs growth was material of expectations, the other elements of the report suggest that the labour market, while still hot, is cooling down just a little rather than overheating. The overall story still seems to be one of slowly cooling wage growth, said Daniel Zhou, chief economist at Glassdoor. Investors reined in the bets on a 50 basis point rate hike in March to 50% from above 80% a day earlier. And Treasury yields, which had jumped to their highest level in more than a decade earlier in the week, fell sharply, helping the broader market pare some losses. On the earnings front, DocuSign's better-than-expected quarterly results were overshadowed by an announcement that its chief financial officer, Cynthia Gaylor, will step down later this year. And Oracle Corporation, meanwhile, reported mixed fourth-quarter results as revenue missed Wall Street expectations, sending the stocks more than 3% lower. Following the results, Goldman Sachs reiterated its sell rating on Oracle in worries about market share losses in the database market, expectations for a slowdown in subscription service revenue, and the impact of capital expenditure pressure on margins. Elsewhere, Gap reported a wider quarterly loss and guidance that fell short of Wall Street estimates. And Credit Suisse described the guidance from the retailer as sobering, but said that there was less risk of further downward revisions beyond the initial guidance. Treasury Secretary Janet Yellen said SVB was one of the few banks she was monitoring very carefully. Reaction poured in from several analysts who discussed the bank's liquidity risks. In fact, a list of 10 banks showing how much they'd reported in unrealized losses on securities is pretty important. Here is the banks with at least 10 billion in total assets, showing those that appeared to have the greatest exposure to unrealized security losses as a percentage of total capital as at December 31. One unique aspect of SVB was its decade-long focus on the venture capital industry. The bank's loan growth had been slowing as interest rates rose, and meanwhile, when announcing its $21 billion in securities sales on Thursday, SVB said it had now taken the action not only to lower its interest rate risk, but because client cash burn has remained elevated and increased further in February, resulting in lower deposits than forecast. SVB estimate that it will book a $1.8 billion loss on the securities sale and said it would raise $2.25 billion in capital through 2 offerings of new shares and a convertible bond offering. That offering, of course, wasn't completed. So this appears to be an example of what can go wrong with a bank focused on a particular industry. The combination of a balance sheet heavy with securities and relatively light on loans in a rising rate environment in which bond prices have declined and in which depositors specific to that industry are themselves suffering from a declining cash led to a liquidity problem. Banks leverage their capital by gathering deposits or borrowing money either to lend the money out or purchase securities. They earn the spread between their average yield on loans and investments and their average cost of funds. The security investments are held in 2 buckets. Those available for sale, mostly securities and mostly bonds, can be sold at any time and under accounting rules are required to be marked to market each quarter. This means gains or losses are recorded for the AFS portfolio continually. The accumulated gains are added to or loss subtracted from total equity capital. And those held to maturity, these are bonds a bank intends to hold until they are repaid at face value. They are carried at cost and are not marked to market each quarter. In its regulatory consolidated financial statements for holding companies filed with the Federal Reserve, SVB Financial reported a negative $1.911 billion in accumulated other comprehensive income as at December 31. That's line 26B on Schedule 8. See the report for those keeping score at home. You can look up regulatory reports for any US bank holding company, savings and loan holding company, or subsidiary institution at the Federal Financial Institution Examination Council's National Information Center. Be sure to get the name right, of course, but otherwise you'll be looking at the wrong entity. Now here's how accumulated other comprehensive income, the AOCI, as defined in the report, includes but not limited to net unrealized holding gains or losses on available for sale securities, accumulated net gains or losses on cash flow hedges, cumulative foreign currency translation adjustments, and accumulated defined benefit pension and other post-retirement plan adjustments. In other words, it was mostly unrealized losses on SVB's availability for sale securities. The book banked an estimated $1.8 billion loss while selling substantially all of those securities on March the 8th. And the list of 10 banks with unfavorable interest margin trends on the regulatory call reports showed that AOCI is added to regulatory capital. Since SVB's AOCI was negative because of its unrealized losses on AFS securities as of December 31, it lowered the company's total equity capital. So, a fair way to gauge the negative AOCI to the bank's total equity capital will be to divide the negative AOCI by total equity capital less AOCI, effectively adding the unrealized losses back to total equity capital for the calculation. So, referring to our list of 10 banks that raised similar red margin flags to those for SVB, here's the same group, in the same order, showing negative AOCI as a percentage of total capital equity as at December 31. And SVB is at the bottom of the list. This data, by the way, comes from FactSet. Ally Financial, the third largest bank on the list at December 31 total assets, stands out as having the largest percentage of negative accumulated comprehensive income relative to total equity capital as at December 31. And to be sure, those numbers don't mean that a bank is in trouble or that it will be forced to sell securities with big losses, but SVB had both a troubling pattern for its interest margins and what appeared to be a relatively high percentage of securities losses relative to capital as at 31 December. Banks with the highest percentage of negative AOCI to capital, well, there are 108 banks in the Russell 3000 index that had total assets of at least $10 billion as at the 31st of December. FactSet data showing AOCI and total equity capital for 105 of them. And here are the 20 that had the highest ratios of negative AOCI to total capital less AOCI as at December 31. Again, this is not to suggest that any particular bank on this list based on December 31 data is facing the type of perfect storm that will hurt SVB Financial. A bank sitting on large paper losses on its AFS securities may not need to sell them. In fact, Comerica, which tops the list, also improved its net interest margin the most over the past 4 quarters. But it is interesting to note that Silvergate Capital Corp, which focused on serving clients in the virtual currency industry, made the list. It's shuttering its bank subsidiary voluntarily. Another bank on the list facing concern among depositors is Signature Bank of New York, which has a diverse business model but has also faced a backlash relating to the services provided to the virtual currency industry. The bank's shares fell 12% on Thursday and were down another 24% in afternoon trading on Friday. Signature Bank said in a statement that it was in a strong, well-diversified financial position. And so an expanding US economy has shown lots of resilience in the face of rising interest rates, but analysts doubt the good times can last. Higher borrowing costs typically slow the economy by depressing consumer spending and business investment. Just look at the housing market, where soaring mortgage rates have crushed sales and new construction. The same could happen to the rest of the economy if the Fed has to jack up rates more than Wall Street expects. Already, a robust US labour market is showing signs of fraying. Jobs postings have declined. Lots of large companies have announced layoffs, and workers who lose a job are taking longer to find a new one. But the Fed is unlikely to determine its next step until it sees the February report on consumer inflation to be published next week. And looking ahead, the US economy cranked up another large number of jobs in February, but there were soft enough patches in the overall report to possibly keep the status quo, another 25 basis point rate hike instead of 50. At the Fed's next meeting, said Sal Guattari, at BMO Capital Markets. No doubt today's data is a reminder that the labour market remains tight, but some investors may be able to squint and see signs of slowing, said Mike Loengrat, head of model portfolio construction at Morgan Stanley Global Investment. Investors hope signs of cooling of the labour market will indeed encourage the Fed to keep raising interest rates in smaller increments. And in the UK economy continued to defy gravity in January, with preliminary estimates showing gross domestic product rose by 0.3%. That means that the rolling quarterly growth rate again avoided slipping into negative territory, despite a sharp rise in interest rates and collapse in consumer confidence at the end of 2022. The numbers give the Bank of England a little more leeway to raise interest rate at its next meeting in 2 weeks' time. Inflation has been running at around 10% for 6 months, higher than anywhere else in the G7. However, it appears to have peaked, and Governor Andrew Bailey went out of his way earlier in the week to say that a rate hike isn't certain at the moment. His opinion was supported on Friday by worse than expected granular data for industrial production and construction output. So the pound rose 0.5% to its highest in 3 days in response. And crude oil prices fell to their lowest in 2 weeks as the SVB news filtered through to risk assets of all stripes. US crude futures were down 0.9% to $75.09 a barrel, while Brent crude was down 0.7% at $81 a barrel. They were gaining little support from a Platts report suggesting that OPEC's output fell some 80,000 barrels a day in February, not from commitments of continued cooperation in setting output levels from Russian Foreign Minister Sergei Lavrov after a meeting with his Saudi Arabian counterpart. Russia has angered some members of the OPEC bloc by unilaterally cutting production to support relative prices for its own exports, which are being shunned by Western buyers due to sanctions. Now, locally, Australian shares plunged 2.3% last Friday as a sell-off in US bank stocks, sparked by concerns over the solvency of Silicon Valley Bank, spilled across local banks, with Commonwealth Bank of Australia shares down 3.3%, National Australia Bank off 3%, and Westpac losing 2.6%. The benchmark index, the S&P ASX 200, fell 166 points to 7,144 as the markets, energy and financial sectors all tumbled. ANZ shares fell 2.6% to $23.85 per share after news broke that it was fined $10 million by the federal court relating to non-compliance over the bank's home loan introducer program. Bendigo Bank shares fell 3% to $9.15 per share after it announced that it would pass on the full extent of the Reserve Bank Tuesday interest rate hike to mortgage borrowers, following 3 other major banks in so doing. Bendigo Bank said it will change the price of its home loan and savings products following the Reserve Bank of Australia's decision to lift the cash rate by 0.25% on Tuesday. And the materials sector fell on a retreat in oil, iron ore and lithium prices, with BHP Group down 3.4% to 45.01 and Rio Tinto fell 3.3% to 117.28. Lithium producer Mineral Resources retreated 6.2% to $83.50 per share. And the falls came as lithium prices extended their losses in 2023. Spot prices in China fell to $49,757 at a 1-year low. Shares of short seller targets Piedmont Lithium and Atlantic Lithium closed down 6.3% and 23.1% on the ASX respectively after the pair responded to a report by Blue Orca Research. And Booktopia shares fell 4% to 23 cents per share after the ACCC handed down a $6 million fine for breaching Australian consumer laws. The federal court ordered Booktopia on Friday to pay $6 million in penalties for making false or misleading representation on the website and in its dealing with customers. The shares have fallen 90% since it went public in December 2020 at $2.30 a share. So you can see here that the cracks continue to show within the financial markets. And I continue to believe that we are quite close now to a financial crisis, which will not just be located in the high innovation areas in California, in the US, but is a signal of more significant pressure among banks in many other countries, including Australia. And to me, the signs are here for markets to continue to drift lower, substantially lower probably ahead, whilst, of course, interest rates continue to move up a little. At some point, we will reach a crisis, and interest rates will then be cut. But if the playbook from global financial crisis runs out, as it probably will, we will see some significant changes and some significant departures among financial services players around the world. And despite what everybody might be saying about the Australian financial system being sound, stable, etc., I can tell you that the pressures are already significantly rising here too. So watch for local failures and amalgamations later. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.